Dutch insurer Aegon has revised its guidance up for the full year as it booked a second quarter pre-tax loss of 435 million euros. Lard Friese, the CEO of the company, now joins us. Lard, just give us a sense of what happened in the quarter, what you're seeing in terms of some of the benefits, but also some of the weak areas.
Yeah, so good morning, everyone, and thank you for having me on the show again. It's all about capital strength. I mean, we are a bridge over troubled water in, let's say, a very rocky half year in the financial markets, one of the most volatile financial markets and the worst start of the year in 50 years for investors. And that is, I think, proof testament to the strategy that we set ourselves out to do a couple of years ago when I joined as CEO, which to ensure that the company is strong in volatile environments. And today we're showing that. And as a result, we are able to raise our capital outlooks for both this year in operating capital generation, but also for the 3-year target for next year, with at minimum 2 billion of free cash flow to be generated. The quarter also saw that our operating result was good and held up well in these volatile environments. Our sales growth in the chosen areas has continued, although asset-based sales have obviously been affected by the lower equity values and the lower bond values. On the net result, we're seeing the effectiveness of our hedge program come through, but also the volatility of the financial markets, because the net result has been impacted by 3 things. First of all, by an accounting noise, I would say, which has to do with the fair value measurement of assets and liabilities of our large hedge platform, which has performed very well, 98% hedge effectiveness, which has protected capital very well. Then the second one is an assumption update review we always do in the second quarter of the year. That is a non-economic and non-cash item as well. And finally, we had to take a charge for reinsurance as reinsurance rates have gone up for a specific book in the US to 200 million.
Lard, as we talk about some of the market uncertainty, we're still setting up for some wildcard data releases. We just had the inflation number to digest out of the States overnight. How much more volatility do you think we're going to have to weather? What sort of quarterly change are you looking at this stage?
We have seen a lot of volatility in the last half year, driven by geopolitical unrest, driven by higher energy prices, inflation, of course, globally, and, still the disruption of supply chains post-COVID. We believe that central banks are, of course, fighting hard against inflation as much as they can. We're seeing labor markets in the Western world strong, but at the same time, we expect bursts of volatility to maintain. I mean, this is not over anytime soon. So what is very important is that we run our models and that we keep adjusting our balance sheet to ensure that at all times and in all scenarios our clients' money is safe to us.
Lard, what kind of inflation are you able to impose on clients in terms of premium price hikes at the moment? Inflation
hits us in a number of ways, affects the company in a number of ways, Jeff. The first one is that of course, it is a headwind for the expense reduction program that we have of 400 million by the end of next year. We are making good progress, and we are at 250 million at this quarter. And we have many initiatives and a very rigorous program to ensure that we are still, in spite of the inflationary pressures, are still able to get to our 400 million reduction target, and we're comfortable we'll get there. Number 2, we make sure that on the balance sheets where we have risk of inflation, that we put hedges in place to neutralize that risk. We've done so in the Netherlands in the back end of last year, and we're also working through many portfolios in a combination of rate increases, but also we're seeing new products and adjustments of existing products and daily benefits in there, etc., to ensure that that we are able to absorb inflation well, and at the same time continue to provide a very good product and service to our customers. It is blocking and tackling, but I think we're doing that very effectively. Yeah.
Let me ask you though. The specific question was really just about premium hikes at this point here, because we know the household is under pressure. Whether it's the UK or other markets that you operate in at the moment. Are you seeing any increase in uninsured losses or reluctance to pay higher premiums?
We see in some books premium rate increases, and we're able to pass them on, especially the long-term care books in the United States. At the same time, we want to make sure our customers are able to continue to afford the premiums that they pay to cover the risks and to make sure that they can live their lives in this environment in a good way. So for us, it's all about reducing expenses. We're passing on some of the inflation risk where we can, but to a large extent, also these rates are locked in. So for us, it's reducing expenses and making sure that we adjust to an inflationary environment. At the same time, as long as inflation is, let's say, followed by higher interest rates, that is good for our company, because we have to reinvest a lot of billions of dollars every year. And if you can reinvest that against higher rates, you're able to pick up a higher spread. That's number one. Number two, you're also able to, the guarantees and options that are in your existing portfolio weigh less strong on the balance sheet. And it makes your products more attractive, especially in the products that are there to accumulate for retirement savings.
All right, Lard, good to see you. Thanks very much for helping us out with the conversation. Lard Friese, CEO of Aegon.